Well, if you are house hunting this morning or hosting an open for inspection, the phrase housing bubble may be on your mind. This week, the Treasury Secretary said evidence showed that Sydney was unequivocally experiencing a housing bubble, as well as parts of Melbourne.
So, what does that mean for home buyers, investors and the property market? Well, we're joined by Ben Kingsley, the Chief Executive of Empower Wealth and Chair of the Property Investment Professionals of Australia. Ben, good to talk to you. Let me first ask you about those comments from the Treasury Secretary, John Fraser, who says when you look at the housing price bubble evidence, it's unequivocally the case in Sydney. Is he right? And what's your definition of a housing bubble?
Yeah, so look, some great questions there, Andrew. The reality is, and I'm actually quite happy that government authorities are coming out and putting some concerns out there for consumers around the Sydney market in particular, and a little bit in the Melbourne market as well. Certainly in Sydney, we're seeing both houses and units have probably peaked in regards to their fair market value in this cycle. So what's actually happening is we're seeing low interest rates, and we've got this momentum of people thinking there's a fear of missing out on this particular upward cycle. So they're probably right in the sense that as interest rates eventually go higher, maybe 2018, 2019, the people who are paying the price today might see the properties that they're buying be valued in 2018 at the same price. So that's going to be a challenge for them, because effectively they're going to be servicing a mortgage and not see any gain from that.
But hang on, what evidence is there that it has peaked in your mind, particularly when you say there's still fear on people, they're missing out on appreciating house prices?
Yeah, look, that's an interesting question, because what's actually happening is there's still households that have double household incomes, and they can service quite comfortably a mortgage that they're obviously going out in the marketplace to secure a property. But what we're actually seeing generally across the market is the affordability threshold. So we're actually seeing where household income is greater than sort of 35 to 40% of their disposable income. Now that means that 40% of their money is out of their household budget is servicing a mortgage. In some cases we're even seeing examples of 45%. Now that's unsustainable in terms of when interest rates go higher, are these people going to be able to run their current lifestyle but also service the mortgage? And that's what we're going to see. In 2018, 2019, we're not going to see a pop of this bubble. We just don't see that in our major cities, because it's still essential need, it's still shelter. So people aren't going to move out of their home if they don't have to, and there's a process to go through. But those people who are finding it harder to service their mortgage are potentially going to have to put their property on the market, and that's going to change sentiment around whether property is a good investment or a good thing to do at that time, and that's going to see the correction occur. So it's not going to bubble, it's not going to pop, but it's going to basically ease its way down, like we saw in the 2001 to 2003 price gain, an upward cycle we saw between 2004 and 2007, some of those gains given back.
How much of an impact, though, is the foreign investment sector in the market, and will we see any changes there?
Miriam, it's really, again, a good question. I think we need to understand, and we need to put it into perspective. The foreign investment that we're seeing is critical for our nation in terms of nation building and basically seeing jobs on the ground and those types of things. We hear rumours of 1 in 5 properties currently being sold to foreign investors. Now, that's money coming into our country that's hitting our GDP line. Those are important numbers for sustainability and GDP growth. Now, so I'm very comfortable with the number of foreign investors who are coming in and showing support for our economy. And they're usually, as we know, they can only buy new property. So they're buying units or they're buying new developments, house and land packages and so forth. So they're taking their money out of their country and bringing it into ours, creating those jobs. What we can't see and what they're not doing is they're not necessarily buying the existing property stock, which a lot of people think that they are. But those potential people who are bidding at the auction could be Australian citizens.
Ben, let me just put a scenario to you then. If interest rates start going up, that puts more pressure on people servicing their debt, and unemployment were also to rise, people losing their jobs, you would see defaults obviously increasing. Would that not be a trigger effect for a collapse in the market?
It won't collapse it, Andrew. What's going to happen is if you're seeing unemployment go higher, usually then there's going to be no inflationary pressure on the economy. And if we don't have that inflationary pressure, interest rates will remain lower. So, you know, it's important to understand that the time that interest rates are going to rise, the main trigger is going to be inflation. Now, obviously that is a challenge for the Reserve Governor and the board in terms of, you know, when we've got really low cash rates, we don't want to see this inflationary asset value occur. What we actually want to see is, you know, businesses spending money and the have-a-go budget actually working. And because we've seen obviously a significant cutback in terms of mining capex expenditure, so we're trying to see the non-mining sector, in other words businesses, start to invest and employ more people. And when we see that, we are going to see obviously interest rates rises, and that's why it's important for households when they're looking out to go out into the property market this weekend to make sure that it is affordable, not just today, but if interest rates were say 1.5% higher, that they could comfortably afford it in their family budget.
Ben Kingsley, we've been focusing on Sydney and parts of Melbourne. What are the prospects though for this sort of an effect to trickle further out to other capital cities around the country?
Yeah, I think as we've said, I think Sydney is very much a dangerous market. In the Melbourne market, I only think it's basically the inner eastern areas where we're seeing houses being built. I have concerns about the unit market, the high and medium density unit market in Melbourne. If we fly around the country and we talk about Brisbane, they're just starting out on their upward cycle. So there's good prospects in the Queensland market. The Gold Coast and the Sunshine Coast are probably going to see a flow-on effect in what's happening in the Brisbane market. Some of the North Queensland tourism markets where the dollar's getting lower, so it's more attractive for international visitors. Some of those areas like Cairns and the Whitsundays could do quite well. And then we look at Adelaide is also just starting in their upward cycle. Perth is experiencing a softening in their particular market, and that's a relationship with the mining sector. As the mining sector softens, so does sentiment and confidence in that market. So we're seeing some price correction occurring in the Perth market. Hobart is, you know, it's a very small marketplace, but it's been quite subdued for a long time. So we're starting to see some life in the Hobart and Tasmanian markets. And Canberra, that had a fairly good run over the last few years, and we're probably seeing that more of a soft market. And then Darwin to finish off, you know, again had a really good time of it in the mining sector boom, and now we're starting to see that soften as well. So we'll probably see flat prices in the Darwin market for a few years.
Ben Kingsley from the Property Investment Professionals of Australia, thanks very much.
Thank you.